For people who aren't familiar, or this is the first time they're hearing this term, cost segregation, can you explain what that means?
We rebranded the name to be accelerated depreciation because so many people have told me cost segregation doesn't really mean anything. It just is like words, right? So it doesn't, but really what you're doing is you're taking, when you buy a piece of real estate, any type, it can be a large commercial property or a rental property, it's the same. You've paid a fair market value for that. And that's one lump number. But when you go to depreciate, that's all you have is the lump number. In reality, you are allowed to depreciate the components of it, but you don't know how much of those components, what dollar value to assign to them to be able to depreciate them more quickly. So it is allowing you to tap into the accelerated depreciation hidden in your real estate that you can't know is there or how much is there until you separate your assets and get a dollar value.
Got it. Okay. So if this cost segregation or accelerated depreciation process didn't exist, what's the time frame that you'd be able to depreciate or write off your rental property?
27 and a half years. Yep.
27 and a half years.
Yep.
Okay. So you take the exact same amount, divide it by 27 and a half years, and that's how much you can write off each year against your taxes. But by doing this, like you mentioned, you could take the components that wear out quicker and front load those and get a
Right.
much bigger write off up front. Got it. Okay.
Exactly. And it makes sense when you think about those components. Essentially, you're going to reverse engineer that purchase price. So let's say you purchase something for a property for $600,000. You want to assign a dollar value to every single item: flooring, walls, doors, piping, toilets, everything until you get sprinkled down to equal $600,000. That's the first step in any cost segregation. Then, once you've done that and you have a dollar value now assigned to your roof or your flooring, then you can look at all of the tax law, which is all court cases actually in this area, and say, what does the IRS allow me to depreciate more quickly? And then you put them into those buckets that the IRS allows. And that's the whole process.
Okay. So that sounds to me extremely daunting when you describe it. If I was to just start listing all that stuff, how does, I guess, I was going to ask you later on about Rental Property Refund, because I know that's the platform that you work with and that I've seen and am really excited about sharing with this community. But how does Rental Property Refund make that process a lot simpler and less daunting so you don't have to look through precedents in previous court cases?
Traditionally, in anything that's complicated like that, you might hire a CPA or you might hire a lawyer, whoever knows that tax law. But Rental Property Refund has created a software that sort of embodies all of that knowledge, which is something that didn't exist before. Traditionally, you had to pay somebody to manually break out your building, your house, because there's differences between your house and the one next door. You might have a hot tub, or you might have X amount of square feet, or you might have some special kind of shed or a nook or who knows what. So it was a manual process prior to this software coming out and being able to really nail down the specifics of your property perfectly and almost automatically.
Yeah. Yeah, that's what I noticed too, because I've done some of these in the past with a CPA firm, and it was really expensive, took quite a while. And then going through this platform, that's why I'm super excited about it, because it's so much quicker and it makes the whole process streamlined. For people who own rental properties and they're curious about what could I potentially save on my taxes, is there a rule of thumb or a ballpark of how that typically works out on a rental property?
Typically, you're going to be able to break out 20 to 25% of your total cost. Now, that's after you take out land. Land's not depreciable. You got to take out a chunk for land. And then the remaining depreciable piece, usually that's the portion that you're going to be able to bring into a short life. But as an example, the best example for me is my husband and I just opened an Airbnb this past year. Now, Airbnbs are actually 39-year assets and not 27 and a half. So you're going to stretch that again another 12 years. So we depreciated, I think it was like 600,000, and we saved 25,000 on our taxes this year and 24. So it's pretty exciting.
Wow. Okay, so just doing rough math here. Let's say we got a $500,000 property Your
Uh-huh.
basis is 500,000 of all your costs. You take out 100,000 for land, so you got 400,000 left over. So you
Mhm.
could front load, say, around $100,000, and then that offsets 100,000 of your income on your taxes, and so that's how that 25,000 kind of worked out there, or it'd be somewhere around that mark.
It's a time value of money concept because at the end of the day, you're going to get the same amount of depreciation over the life of your asset, 27 and a half years, but you're not going to hold it that long. So if you
Yeah.
can bring depreciation from those back years and pull it into year one, then it's yours. Then you get to take it and then you can sell it after 5 years, 10 years, rather than waiting 27 and a half years when that same dollar deduction is now 30 years old and has been chipped away with inflation.
Yeah, that makes total sense. This idea of depreciation is that amount forgiven then, or does it, when you depreciate the asset, technically you're lowering the basis, and
Mhm.
once you go to sell it, then there's going to be a higher profit margin or a higher spread between your basis and what you're selling it for, so potentially higher taxes then. So, what are there strategies that people use to offset that then, or what can you speak to about that?
That's a complicated area and there are strategies, but in general, you're talking about the recapture. So what happens is if you, let's talk about the 5 year asset. So the items like flooring is a big one that you can put into a 5 year life. If you, what you're doing is you're using accelerated depreciation there, which hence the accelerated depreciation. Straight line depreciation is your regular 27 and a half year. So there's a rate play delta there. So if you've held your asset for all of 5 years, then you're going to only recapture it as if you did straight line, if this makes sense, which is only is 25% as opposed to 20% for your gain. So the delta
Hmm.
is very small, but you've got the benefit at your ordinary income rate, which depending on where you are, could be 24, 32, 37%. And if it's offsetting your W-2 income because it's a short-term rental, then you're also offsetting Social Security and Medicare. So your benefits usually way outweigh what you're going to get back on the back end. If you want to avoid it altogether, you can do a 1031 exchange if you're buying another rental property, and that's going to defer it. You can also just let your kids inherit them and they're going to go to them tax free. You'll avoid it that way too. All of it, all of the gain. So there's a
Yeah.
couple of different strategies depending on what your long term plan is.
Yes, absolutely. No, I think that makes sense. And I think I appreciate you sharing that because it's a whole rabbit hole we could go down and there's a lot of nuance to it. But I think a lot of people are afraid of that. And so they trade off paying high taxes because of the fear of depreciation recapture when there's strategies like a 1031 exchange or others where you can really defer taxes in a perpetuity, really,
You
if you
really
want to,
could.
if you're
And
smart about it.
one of the things that people don't understand is that you will be subject to recapture no matter what. I've met many people who just don't depreciate their properties at all because they don't want recapture. You're still required to recapture the depreciation you should have taken. So you just really messed yourself up by doing that. You
Yeah.
can't get out of it.
And I think a lot of my audience works W 2 jobs, and maybe a lot of them probably have the goal of eventually living off rental properties, thus the name of the podcast, and probably why they're listening. But in the meantime, I know there's certain rules around using this accelerated depreciation to offset W 2 income. Can you speak to that and what's the difference between short term and long term rentals?
The main difference between the short term and long term is short term is defined as on average your stay is 7 days or less. So you're really turning over your clientele frequently. In tax law, hotels are an active business. And so they are considered a 39-year asset. And so that's really where you're going with your short term rentals. You're taking it out of the whole rental rules that make you have to have passive income and loss. You're taking it into the active business realm. And by doing that, the first step is to have your rentals be on average 7 days or less. The second thing is you need to be active in the business. So you need to be booking people, talking to people. If you have a management company, you will not qualify. This is going to go back into the passive bucket. But if you're doing that yourself, maybe even doing the cleaning yourself, you have to be putting in more hours than anybody else, including those cleaners. So for us, we do the cleaning. We do with the talking to people on the Airbnb back and forth and all that. And so that qualifies. But here's the trick with it. The first year you buy your property, you do that. And it can be like in September. So you do that through December and then it's active. And then you can put that on your return. And then maybe next year you hire a management company because now you've taken your extra depreciation. So there's
Yeah.
strategies around all that stuff.
Yeah, no, that's really smart. And part of what I teach to people who I coach in this is to manage your own properties because most property managers charge 20 to 30% for
Yes.
short-term rental property
Yeah.
manager. How about with long-term rentals? Can people still do this strategy?
Long-term rentals are going to be passive and they are going to be, but you can still do accelerated depreciation, also cost segregation. You can do that as long as you have income in your passive bucket. So for taxes, you've got active income, you have passive income, and you also have portfolio income. Portfolio is like interest and dividends. Your passive is going to be largely your rental properties. So if you have enough, and if it's a short-term property, even if you have a management company, you still might be making a really great revenue. If you're paying tax in that bucket, then it's definitely going to work for you.
And then I know that there's talk about the amount of depreciation that you're allowed to take each year. There was changes that Trump made during his first administration. Now they're talking about changes. What's the current percentage of the accelerated or bonus depreciation that you can take, and what are the potential changes around that?
Okay, so the first thing to think about is that accelerated depreciation is different than bonus. They're two separate things. First, you put your money into your buckets, and then those buckets get, for that 5 year asset, normal depreciation. You depreciate 20% of it in year one, 40% in year two, and then it goes down. It's called double declining balance. Now, what bonus does is on top of that. So let's say we put $100,000 into that 5 year bucket. Bonus says whatever you put into these short life buckets, and it's not just for rental properties, go ahead and just expense a portion of that, and that's the percentage right away in year one. And the remaining left over. So let's say right now we're in a 40% bonus year. You asked that. 40% of that, so $40,000, boom, would be expensed in year one. Then you take that remaining 60% and depreciate it over 5 years. So that's how that would work. So in a year we have no bonus, you just depreciate over 5 years normal. In a year with 100% bonus, you're going to just wipe out the whole balance and just take it in year one, and it never had to live out its 5 year life. So what happens is Congress uses that as a lever to stimulate the economy. Rental properties is U.S. investment. They like that. So they will give us different bonus rates at different years. It happens every year to try to stimulate things.
Yeah, that totally makes sense. And yeah, I was conflating the two of the accelerated depreciation and bonus depreciation, but that makes sense. And there's a lot of talk, I think, that we're going to go back from 40% up to 100%. What's your thoughts on that?
I don't know if we'll go up to 100. If you look throughout history, so bonus depreciation started in the early 2000s. Most years we've had 50. It was really just a couple years there when Trump was in office last time that we got the 100. He might bring 100% back. It depends. There's so many things that they look at up there, but I do think they're going to have to strengthen it for sure. But one of the things that you should think about if you've bought a 2025 property and you're not sure if they're going to change the bonus rate and if it's going to be retroactive to January 1st, which is what we think might happen, then you still are better off to go ahead and do a study and you've got your numbers, because if you're paying estimated taxes, especially on your rental income, then you could go ahead and offset your next payment with what your benefit's going to be. And then after you've done the study, if the bonus rate changes, we will email everybody with new studies and with your new numbers before you file. You just have to have your numbers solidified before you file in 25. But it's going to help you with your planning to go ahead and do it now, and even plan for your 40% because you've got that. Reduce your estimated tax payments by that amount. And if the law changes, then reduce maybe your third or fourth quarter payment a little bit more.
I was going to ask about the timing on it. So it's not like you have to have the cost segregation done by the end of the year. It's just prior to filing your taxes the following year. But by doing it now, you can see how much you're going to save if you have a property that you purchased this year.
I don't want any surprises. And it's just good cash flow planning to not pay extra to the IRS ever. So you don't want to be paying in based on a full amount and then at the end of the year get a refund. That's just tying up your cash. So yeah, that's the best strategy.